The pace of inflation is cooling. The annual rate came in at 7% in August, Statistics Canada reported this week. That's down from the 4-decade high we saw in June. But that doesn't mean prices are coming down. Even the most optimistic scenarios forecast prices will continue to climb even as inflation comes back under control. It's more that price increases will be slower rather than prices will be falling, says BMO senior economist Benjamin Reitzes. The best case scenario is that higher interest rates and a cooling economy will lower inflation to a more moderate pace. Right now, overall inflation is slowing, but it's mostly being dragged down by a lower global price of oil. Reitzes says consumers shouldn't expect that to happen with other goods and services. Welcome to Savvy Economists. The numbers pose a ray of hope for Canadians who have been stuck in an overwhelming cycle of rising prices, housing problems, and unemployment. Unfortunately, however, it only says inflation rates are down without any comment about the effects on already hiked prices of goods and services. As we go into the video, hit the like button, make sure you subscribe and turn on notifications. As higher interest rates increase borrowing costs and bite into economic growth, some of the biggest and earliest drivers of inflation are coming back down to earth. Oil has fallen precipitously this year. The cost of shipping is almost back to where it was pre-pandemic, and the price of key grains and corn have fallen as well. But the cost of food and services is still pushing higher. Food prices rose 9.8% in the year up to August. The fight to get prices down will rage on. Economists expect the Bank of Canada will push ahead with its plan to hike interest rates even further. Inflation likely hasn't slowed far enough or for long enough to convince the Bank of Canada that further interest rate hikes aren't necessary, wrote CIBC economist Andrew Grantham. That means Canadians already pinched by higher prices will be further squeezed by increased debt payments. The economy will slow and jobs will be lost. Pedro Antunes, the chief economist at the Conference Board of Canada, says we haven't had this kind of inflationary surge in decades, so people forget just how insidious it can be. He says inflation devours our purchasing power. Sure, the cost of just about everything is surging, but wages aren't keeping up. Wages are falling when you factor in increased costs. Real wages are calculated by subtracting wage growth from inflation. Antunes says that the gap between wage gains and price growth is now baked into the economy. We're going to see this kind of being a tenacious hit to our ability to buy goods and services. And even though price growth is slowing, it will take a long time to get costs back into the window the Bank of Canada has deemed acceptable. The central bank would like inflation to grow between 1% and 3% each year. Claire Fan, an economist with RBC, says how quickly inflation can get back into that window depends on how aggressively the Bank of Canada boosts interest rates. Fan says her forecasts show inflation won't get back into that window until the end of next year. That's what we are hoping for, she says. But that is contingent on the Bank of Canada to hike rates to 4% by December. But she says Canadians need to remember, slowing inflation will not mean a return to where prices were before all this started. To see a deceleration in the rate of price growth is what we're all expecting, not an outright decline in prices, she says. After all, the alternative to rising prices is much worse. An actual decline in prices would set off a whole new crisis for the economy. Deflation happens when prices fall across the board and the numbers in the Consumer Price Index, a basket of goods and services, turn negative. Suddenly people stop buying things, the economy contracts and jobs are lost. It puts a lot of pressure on the economy. It also makes it extremely difficult for central banks to stimulate the economy when you're in a deflationary environment, says Reitzes. It's also a cycle that is notoriously hard to break. Just look at Japan, he says. Japan has been struggling with deflation for decades. Various governments and different central bankers have tried just about everything to get out of it. They've been doing their best to get out of it. Whatever they can do, they've done. The government spent a lot of money and the central bank has expanded their balance sheet, says Reitzes. It's been a generation since Canadians were faced with these sorts of questions. Across the country, people are struggling under the weight of rising prices. The cure is higher interest rates, which leaves indebted households even more squeezed. Price growth is slowing, but the surge of this past year has set a new normal, a new level from which, if we're lucky, prices will continue to rise from, just at a more manageable rate. The Bank of Canada is officially charged with setting Canadian interest rates. And as the Canadian Central Bank's Deputy Governor, Paul Beaudry, insisted Tuesday following the latest inflation numbers, it is still in the case. We want to have inflation down at 2%, Beaudry told a gathering of students and professors at the University of Waterloo in southwestern Ontario on Tuesday afternoon. That's where it was for a long time. Now it's running way above. Beaudry saw some good news in the fact that Canadian inflation continued to decline from its highs. But the fact that price rises remain broad-based, in other words, affecting a lot of goods beyond food and fuel, was one more dangerous sign that inflation expectations were stubbornly planted in the minds of Canadians. He said it could reasonably take 2 years to dislodge that kind of inflationary thinking from the perceptions of businesses, considering how much to raise prices and earners planning to boost their wage demands. Beaudry said the bank's method included more large interest rate hikes, combined with a strategy of communications, to try to convince rational economic thinkers that inflation would come down. Beaudry said he hoped to get back to lower inflation with the least possible disruption on the real side of the economy, but added that the Bank of Canada would do whatever it takes. That was read by Desjardins' managing director and economist Royce Mendez as saying the bank would accept a recession if necessary to crush rising prices. While Bank of Canada rate hikes affects Canadians, what the U.S. central bank, known as the Fed, does is crucial to the lives of consumers, homeowners, and investors north of the border as well. According to some economists, what the Fed does may have a bigger impact on Canadians than interest rate changes by Beaudry and his team. Certainly, anyone with a stock portfolio who watched markets plunge Tuesday on fears of rising U.S. interest rates would likely agree. Less than 2 weeks ago, the Bank of Canada's senior deputy governor, Carolyn Rogers, suggested that a rising loonie, charged up by energy exports, would act as a pad against inflation in Canada. But since then, the Canadian currency has tumbled to its lowest level in 2 years. That makes imports, especially from our biggest trading partner, the elephant, more expensive, pushing Canadian inflation higher. Even as Canadian domestic prices begin to fall, many internationally traded goods, including oil and animal feed, are priced in North American markets. A lot of our food comes from U.S. farms, but even products from outside the continent, such as grapes from Peru, are cleared through U.S. ports and priced in U.S. dollars for the U.S. market. What you pay for your house is also at least partly made in America. While the rule of thumb is that short-term mortgages in Canada are pegged to the Bank of Canada overnight rate, longer-term interest rates are based on bond prices set in New York as lenders hedge against further rate increases. And as mentioned, while some economists expressed optimism that the Bank of Canada could scale back interest rate increases, anyone with investments in the stock market or holding long-term bonds had little reason to be thrilled by that prospect. U.S. and Canadian stocks and even cryptocurrencies declined sharply on Monday. Bitcoin plunged below $19,000 US on fears of what Jerome Powell, chair of the Federal Reserve, might do the following day. Bank of Canada Governor Tiff Macklem has said in the past that the only practical way to prevent inflation from repeatedly stealing buyer power from Canadian wage earners is to use rising interest rates to bring inflation under control. But that is hard when so many of the price increases we see arrive with global imports. While Canada acting alone might not have a lot of clout on world prices, if the U.S. Federal Reserve decides to use all its might to clobber global inflation, Canadians may also benefit. Gas prices fell by 9.6% in August from where they were the previous month. That is the biggest one-month drop in gasoline prices since April 2020, when the pandemic was just beginning. While gasoline got a little cheaper, food prices continued their increase. The cost of groceries has risen by 10.8% in the past year. That's the fastest increase in the typical grocery bill since 1981. The supply of food continued to be impacted by multiple factors, including extreme weather, higher input costs, Russia's invasion of Ukraine, and supply chain disruptions, the data agency said. The cost of edible fats and oils is up by almost 28% in the past year, while coffee and tea prices are up by more than 13%. Bakery products are another standout, up by more than 13% in the past 12 months. Pedro Antunes, an economist with the Conference Board of Canada, says that while high and rising food prices are problematic, he's seeing encouraging signs that some prices are starting to come down. Although still up on an annual basis, prices for proteins like some frozen meat, fish, eggs, and nuts were lower in August than they were in July, according to Statistics Canada. When we look at the commodity prices for grains and red meat and other products, some of those prices are starting to come down, he said. Every month, the inflation rate fell by 0.3%. That's the biggest monthly cool down since 2020. And so-called core inflation, which strips out volatile items like food and energy, fell to 5.2%, down from 5.4% the previous month. The relief in core inflation provides a powerful signal that the Bank of Canada's rate hikes are having an impact, said Toon Nguyen, an economist with consultancy RSM Canada. But even at 7%, the official inflation rate is still more than twice as high as the central bank likes to see. This means consumers and borrowers should expect even more rate hikes to come. Grocery prices still rise rapidly. Rapid wage growth means inflationary pressures remain, so it is not yet time to breathe a total sigh of relief, Gwen said. Prince Edward Island resident Jennifer Cullen says inflation is nowhere near being under control for her family. She tries to save money any way she can, she said, and one way she's managed to stretch those pennies is by shopping at vintage and used clothing stores. My kids are very active and they grow very fast, so I'm changing shoes and clothes every 2 months with one of my boys, she told CBC News while browsing the aisles of Repeat's clothing in Charlottetown. Store owner Mary Matthews says she's noticed an uptick in sales of late as families stretch their budgets. And while higher sales may be good for her bottom line, her costs have increased too, as her inventory costs about twice what it did last year. It's hitting all of us, Matthews said. Everything is costing more. Demand continues to outstrip supply in many parts of the Canadian economy, and short-term inflation expectations of Canadians remain high, said Rogers to Calgary Economic Development, a privately and publicly funded agency. The solution, said Rogers, was to use a sharp rise in interest rates to crush demand, offering to supply a chance to catch up. While cooling inflation may be a piece of better news than what has been in the headlines for some time now, it doesn't provide any concrete hope for Canadians, as the Fed raised interest rates on Thursday, which indirectly also has an impact on Canada's economy. Increasing interest hikes in the short term helps to curb inflation, but when prices of commodities remain high amidst all these, it seems like the numbers shown are not really what they are. Do you think the rising interest hikes would eventually affect the prices of goods and commodities, or will this be another wild goose chase? Let us know what you think in the comment section below. Don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.